All right, it's November 7th. The goal here is simple. Cut through the noise and build a clear, actionable framework for the next 1 to 3 months. Let's get right to it.
Before we dive in, a critical data caveat. You'll see future dates and hypothetical market levels in this analysis. I need you to focus on the strategic logic and the relationships between these drivers, not the literal price points themselves, okay? Let's move on.
All right, Section 1, Market Noise versus Signal. Look, in any market, especially this one, the most important job is separating the short-term distractions from the real, durable trend. That's what we're here to do. So here's the current battlefield. On the left, you've got all the noise. Government shutdown drama, sentiment hitting extreme fear, conflicting consumer headlines. It's just chaos. But on the right, that's the signal. A multi-year defense spending cycle, the structural onshoring of supply chains, and some really deep valuation dislocations. We're focused squarely on the right side of this slide. Section 2. This leads us directly to our first high-conviction theme, which is built on the structural signals, defense and industrials. This quote right here from the U.S. ambassador to NATO, it says it all. Ukraine is the battle lab of the future. Think about that. This isn't just a conflict, it's a real-world R&D accelerator. It's forcing rapid tech adoption and a massive production ramp. This is not some cyclical blip, it's a fundamental paradigm shift. Okay, so let's look at the hard data backing this up. For aerospace and defense, the catalyst is clear. NATO spending pressure and proven demand from the battle lab. For industrials, you can see the onshoring trend in black and white. Boeing is ramping 787 production to 10 a month, adding 1,000 jobs. And in materials, you've got the first major rare earth plant outside of China in 20 years. That's a huge deal. Tickers are on the screen for your own work. Section 3. Now we've got to address the other side of the coin, the cyclical risks that are creating all this noise and volatility. We're talking specifically about the shutdown and the very confusing consumer. Yeah, the shutdown's impact isn't some abstract concept. It has direct, measurable effects. For airlines tracked by jets, it's a clear negative. You get flight cancellations from unpaid air traffic controllers. Simple cause and effect. On the flip side, it's a positive driver for volatility. The VIX stays elevated because of all the uncertainty and headline risk. And this brings us to the consumer, who's being pulled in two completely different directions. The bull case? You've got disinflation in staples, that Walmart bundle is reportedly down 28% year over year, and real wages are growing at about 1.5%, according to the Atlanta Fed. But the bear case says those promotions just signal weak demand, the shutdown furloughs are a direct hit to spending, and that extreme fear sentiment is going to make people save, not spend. This conflict, this uncertainty, is absolutely key to understanding the current market. Okay, before we get into scenarios, the mandatory disclaimer. This content is for educational purposes only. We aggregate public sources to help you stay informed so you can improve your own decision-making. Always do your own research. This is not financial advice. And a quick ask, if this framework is helping you, please take a second to like and subscribe. It really does help the channel reach more viewers, and your support is greatly appreciated. All right, Section 4. Let's put all these pieces together into a practical framework with 3 distinct scenarios for how to position. So our base case, what we see as most likely, is that this political gridlock just continues. What does that mean? It means the S&P 500 probably stays range-bound and the VIX stays elevated. The way you win here isn't by betting on the broad market. It's through sector rotation into those structural themes we talked about. So the posture is clear. Overweight defense and industrials, hold some tactical hedges for the cyclical risks, and keep some cash ready. Now for the bull case. The trigger here is very specific. A resolution to the shutdown. The confirmation is seeing the S&P 500 break and hold above near-term resistance. If that happens, sentiment could flip from extreme fear in a hurry, and you could see a sharp year-end rally up toward that 7,300 to 7,500 target. The invalidation is just as simple. If it can't hold the breakout levels, the thesis is dead. And then there's the bear case. The trigger for this is the shutdown dragging on through Thanksgiving, which starts to cause real economic damage. Confirmation, a clean break of key support levels on the S&P. That could kick off a negative feedback loop where weak consumer data and political risk feed on each other, driving a much broader sell-off. Invalidation would be a surprise bipartisan deal. Okay, Section 5. This is where we translate all that analysis into a couple of specific risk-defined setups. Let's see how the framework looks in action. First setup is a contrarian value play in Fiserv, ticker FI. The thesis is simple.
The market absolutely hammered the stock on an earnings miss, creating what looks like a deep value opportunity. We're talking 7 to 8 times free cash flow with a new management team stepping in. This has a dual horizon. You're monitoring the turnaround over the next 1 to 3 months, but the core thesis could take 1 to 3 years to play out.
So, how could you structure this? For a higher risk tolerance, you might look at long-dated call options, something like the Jan 2028-65 strike. What you're exploiting here is the huge sentiment dislocation and the high implied volatility. Your max loss is defined, it's the premium you pay. The invalidation point is if the new management can't stabilize the business in the next 2 quarters. This is a starter position, not something you go all in on.
Setup number 2 is a structural momentum play, and it's right in line with our core theme, Boeing, ticker BA. The thesis is built on durable tailwinds. You have the 787 production ramp-up, a strong order book with 37 new planes just confirmed, and it all fits into that bigger onshoring trend. The horizon here is shorter, 1 to 3 months.
For Boeing, a potential structure is a bull call spread. It's a defined risk way to play these positive, company-specific catalysts. Your max loss is capped at the net debit you pay to enter the trade. The thesis is invalidated if they revise guidance down because of production delays. This one could be sized as more of a core position, and you could look to add to it if it confirms above key technical levels. All right, another mandatory warning since we discussed options. Options trading involves substantial risk. It is not suitable for everyone. Your capital is at risk, and losses can exceed the premium you paid. You absolutely must use disciplined sizing and stop-loss strategies. And the final disclaimer, this is not trading advice. It's a market update to keep you informed. All markets carry risk. You need to trade your own plan, manage your downside, and please, verify all this data for yourself. So I'll leave you with one question to think about. In this kind of environment, full of political noise and extreme fear, is the greatest risk being wrong, or is it being paralyzed by it all?